The through line really is like betting on the innovation economy at different stages across those cycles.
Welcome to Partner Path, a podcast that unpacks the venture capital and growth equity ecosystem from a junior perspective. Young entrepreneurs and investors have already had a massive impact on the industry, having started unicorns and launched billion-dollar funds. We discuss these success stories and more by sharing perspectives and advice from some of the industry's most prominent role models. This podcast expresses our views as of the date published and does not represent the views of and is not endorsed by any company for which we work. Before we get to the episode, Laura and I are excited to announce a partnership with Overlap. Fresh out of Y Combinator's summer batch, Overlap is an AI-driven app that uses large language models to curate the best moments from podcast episodes. Imagine having a smart assistant who reads through every podcast transcript, finds the best parts or parts most relevant to your search, and strings them together to form a new, curated stream of content. That is what Overlap does. I personally use Overlap to explore content on future podcast guests and highly recommend it as another diligence tool for investors. Check out Overlap on the App Store today.
Today we are chatting with Teddy Himler, founder and general partner at Optimist Ventures. Teddy started his career at Goldman and then VC at SoftBank, Comcast Ventures, and Antler, co-leading their $285 million global VC fund. As of a few weeks ago, Teddy launched his own fund, Optimist Ventures. Welcome, Teddy.
Thanks, Laura. Thanks, Will. So happy to be here.
Let's go back to the early days of SoftBank. You actually started at SoftBank, and then you left SoftBank, and then you joined again. Maybe just chat about that transition and why you decided to go back, which was in 2018.
Yeah, absolutely. So I indeed did boomerang. I first showed up at SoftBank in 2013 after a stint as a tech banking analyst, and I was working one weekend as the tech banking analysts do, and my boss had me do a couple pages for SoftBank at the time and introduced me to what was then the main representative in California. So that was early days. It was pre-vision fund, and we had an early stage fund and a growth investing vehicle under a brand called SoftBank Capital. And turns out, actually, where we're recording this podcast is about a block away from where the initial SoftBank Capital office was. I helped establish an office. We did growth equity investments, things like Fitbit and Cabbage and Criteo. And then in a weird turn of events, I became infatuated with the opportunity in emerging markets along with my boss. And, he said to me once, SoftBank is like the sun. Not only does it get quite hot sometimes, but also there's some fascinating things that orbit it. And on occasion, you can go and jump on one of those things. And so he and I ended up starting a $50 million fund together. It was focused on the emerging Southeast Asia tech scene. So I felt like I was transported back in time to the late 90s, but instead of Silicon Valley, I was based in Jakarta. And so I spent a year investing in what was Internet 1.0, in fintech, ride-hailing, e-commerce, and actually that fund did quite well. But I was on an island very far from my home here in New York. And after 3 years of working on the fund, I came back, and SoftBank at the time had no office in New York. That had gone away, and so I joined the venture capital arm of Comcast Ventures, which was great. I ran, like you guys, I ran up and down New York, meeting all the founders. There was a booming fintech wave. There was a booming ad tech and new media wave happening at the time in New York. And I was mainly doing seed Series A investing for Comcast Ventures for a number of years as one of the lead principals here. But this was like 2018, right? And after a couple of years at Comcast, I just missed the arena of SoftBank. You had Masa on the cover of The Economist, the one-man bubble maker. You had large investments in things like ByteDance and, most ignominiously WeWork. And I wanted to go back. So I did another couple of years at SoftBank under a great leader named Marcelo Clare, who was not only the CEO of Sprint, he became the chairman of WeWork. He now has his own fund and family office, but worked for Marcelo for a number of years back here in New York before, and then Marcelo left and I joined Antler, which harkens back to my days of Southeast Asia, where, if I may, Antler had grown from humble roots in 2017 as a single accelerator in Singapore. The founders I was very good friends with when I was living out there, and it's now, believe it or not, the most active investor in the world. Because of a different architecture, at Antler we'd had 14 regional pre-seed funds running accelerator programs in 30 cities, 20 countries. And so it became quite sprawling, and I got to live through that, which was an amazing experience over the past 4 years. So if I think about those 15 years, I've traveled to a lot of countries, a lot of passport stamps, but got to see tech at different stages and geographies and sectors. But the through line really is like betting on the innovation economy at different stages across those cycles. So it's been a great run so far.
Yeah.
And how did that influence your investing style today by being a part of those different waves in Southeast Asia?
I think I'm a historian, like in my style. And that may sound geeky or academic, but I think what Southeast Asia enabled me to do was test out kind of a theory I'd had of tech investing, which is you study the prior waves. So I'll give an example in e-commerce. We had studied the rise of Alibaba and JD.com in China. We had studied the rise of Flipkart and Snapdeal in India. And then we funneled those learnings into what was a Series A investment into a company called Tokopedia. At the time, I remember the company was doing about $200 million of merchandise value on the platform. We had found them in Jakarta, and it was the fastest growing e-commerce company, but it was still quite small. But very uniquely, the way that they had architected the platform was so similar to what Alibaba had done. They had borrowed, a lot of those learnings. And because they had an escrow system that created trust, it felt like, that was the key to success with Alibaba, with Snapdeal in India. And then so I ended up bringing to Masa and the SoftBank team what became the largest investment in Southeast Asia at the time. The company now, you flash forward, it's like probably 10 years or so, represents a casual 3% of Indonesian GDP. It's like tens of billions of gross merchandise value in the platform. And I think most impactful for me, it helped create a lot of e-commerce jobs on the archipelago, which I thought was really neat. So if I bring it back to it, I was able to study the prior waves in different countries, the business models, and then apply that to what I'd seen in that region. I think that really solidified my thinking. You bring that back to developed markets, and almost every investment I do, I feel like it ties back to some history. Oh, we had backed this. There was a similar company in the HR recruiting space that we backed in 2002. Why is this different? Why now? And I think I approach almost every investment with that sort of historical mindset.
What did you see from a valuation standpoint investing over there, and how would you compare it to the U.S. valuations and maybe even exit strategies?
Yeah, it's a great question. And this is always the conundrum of emerging markets investing. Certainly there's a discount. There's less capital in some of these regions, so you don't need to bid up valuations as much. However, it's not as low as you think. And in venture, we're not value investors, right? Like even if you get a 20% discount on valuation, that's not going to make or break your investment thesis, right? This is not even a home run business. It's a grand slam business, right? And so getting a 10% discount on valuation won't make the difference. What's interesting, I think, about emerging markets is you don't need to reinvent the wheel. You're not taking as much product market fit risk. You're taking adaptability risk. You need to adapt to those idiosyncrasies of the markets in some of these places, in Korea or in LATAM or in the Middle East, but you don't necessarily need to create 0 to 1 innovation. You borrow, right? And you innovate on that. And that, in a way, you ought to pay a premium for. So net, I think you are getting a discount, but it's not as great as people think. And you feel more comfortable, at least I do, when you're betting on a business model that you know works. Not everything works in venture. Most things don't, right? And so by removing that risk, there is a certain confidence that gets built, I think.
One other thing that would be important to touch on is sourcing in these regions. I'm sure your network wasn't as strong as it is in the US, and finding special entrepreneurs. It's a small ecosystem, but you want to find and build relationships with the right people. And someone you invested in actually saw an ad for one of your programs you were running in Singapore. So I would love for you to touch on how that ended up working out and what exactly the ad was.
This is a great story. So there's a company that is currently out of Dubai that was previously out of Singapore, that was founded by a Turkish entrepreneur. We're fond at Antler of saying talent is evenly distributed, but capital is not. This is a guy who was building maritime connectivity solutions for his transport ships as a crew member going through the Bosphorus and the Mediterranean. And he was an expert in understanding that connectivity, how to wire into existing telcos as the crew would go from port to port. He was leaving Turkey for a variety of reasons, and he ended up getting recruited by our Antler Singapore fund. And we helped him get a visa, moved to Singapore, was noodling on this idea of creating an aggregator of virtual embedded SIM cards. So turns out there's this technology change, which at SoftBank I saw at ARM as they architected it, but it's basically, instead of popping out a SIM card, you now can program the SIM card over the air. So when you're on your European vacation, you can, in Italy, get 10 gigabits for $10 over the air. You don't need to go to the kiosk and buy the physical SIM card. He noticed this technology change, wired up 120 carriers around the world through API connections, and created what became one of the first and now the most popular eSIM aggregator. And the first name of the company was kind of funny. It was called Air GSM, which is Air Global System for Mobile Communications. If you pronounce that phonetically, it's Airgasm. But I think he had to change the name, and now it's called Iralo. And it's well known by travelers, and it is this great service that does a couple $100 million of revenue now at a really nice margin, at both gross and EBITDA margin. So really phenomenal business that emerged in the last 4 years, right out of COVID. So from that perspective, if there was any example that innovation can come from anywhere, it's that company.
Yeah.
Yeah.
And now Optimist Ventures, we'll get into the strategy later, but part of the strategy is you look to invest behind inflection points.
Yeah.
I think a lot of people would argue that this is a personal inflection point for you creating a new firm. And I would encourage those listening to go read Teddy's blog post about it. But maybe just touch on what pushed you to start Optimist as opposed to sticking around at Antler. What was kind of the catalyzing factor?
Yeah. So like anything, it's one of these overnight changes that's 15 years in the making. I think one of my idols in venture capital is Brad Feld. And I'm sure you all read the book as students of the game or Venture Deals. And Brad, I went to breakfast with when I was in college, and I saw what he had done. He left SoftBank actually, like in the 2000s, and he founded Foundry Group out of Boulder, Colorado. And they made a bet on themselves. They went back to basics venture, small fund sizes, doing the same thing every couple of years. And he did that for 20 or 30 years. And I had the opportunity to work with him a little bit on Fitbit. He had a casual $1 billion return on that company. And I've seen how over the past 15 years, I've always said, well, I'm going to start my own firm one day. And for a variety of reasons, my track record maturing a fair amount. I mean, it takes a long time, right?
Yeah.
I had one investment, it's called Dialpad. I was in it pre-revenue. Craig Walker will be an advisor to this fund, but it's now doing 300 of ARR, but it's taken 15 years. Yeah. It will go public in 2025, but we invested in 2013. And so track record maturing, stability in terms of, many aspects of my adult life. I think the macro is actually a factor, and it's very Dickens. It's the worst of times and the best of times. There's a tremendous amount of illiquidity. There's interest rates are still high. There's a lot of LPs that are just sitting on the sidelines. However, you have these incredible technology changes that are occurring all across the world in AI and other critical technologies. And as we come out of this capital cycle where I think we've bottomed out and we're coming back again, I think that's exactly the right time to start something. The last piece of it is Antler, and I owe Antler a lot because it had given me most of all confidence. Antler, I joined, we were probably 100 or 200 of AUM. Now Antler's $1 billion of AUM, and I've been a part of that journey. I was able to run a fund. So it was a $285 million fund that I ran with two partners. Very different than angel investing, very different than balance sheet investing at Comcast Ventures or SoftBank. It is a skill of thinking about portfolio construction, reserves, how you're thinking about how this plays with the existing strategy, how much do you alter the strategy as you learn and go along, and then most of all, these LP relationships too that I've developed over the past couple of years. So you add all those ingredients together, and I think you get Optimist Ventures.
Now, a quick word from our sponsor. Laura and I are thrilled to announce a partnership with Grata, an intuitive deal sourcing and diligence platform. Keep missing out on private market deals? Ditch the Rolodex and get Grata. Grata's AI-powered platform provides accurate data, deep insights, and time-saving workflows that help get more deals done. And it's trusted by over 500 firms and 3,000 deal makers, including myself. I've personally used Grata in both my deal sourcing and diligence workflows and would recommend their tool to any investor across private equity, growth equity, corp dev, or investment banking. We've negotiated a special offer for our audience. Mention PartnerPath to the Grata team during sign-up, and you'll get free executive seats for your partners and MDs included in your subscription. Now, back to the episode. I want to touch on for a second, you mentioned cycle timing and where you think we are, which I largely agree with, but I think a lot of people will take the approach or thought that one of the benefits of being in venture is that you're less susceptible to cycles and macro timing. And so I'm curious to get your thoughts. How important is it to try and time a cycle or the macro environment when thinking about launching a venture fund or making venture investments?
Yeah. I think the macro is really important. I think you have the secular and the cyclical. So, the secular trends in technology around innovation increasing exponentially, globalizing very fast in a wide variety of domains is clear to me, and is, betting on the next 30 years of innovation cycle and shortening half-lives of companies and new categories being disrupted, innovated upon. That's very clear. The cyclical, I think, is always going to be there. And I think about the history of cloud and mobile, right? Like, you had a massive correction in the early 2000s, and Facebook was founded in 2004. That kicked off a whole another, mobile social cloud, 12, 15 years around. So I think oftentimes when you get these corrections, it's the best time to invest.
Yeah.
There's another trend too, by the way. I think there's a lot of illiquidity. We all know that in venture capital. But increasingly, I'm just seeing like an ice sheet thawing, a blending of the public and the private markets. There's secondary transactions. It's becoming a much more active, involved asset class. And I think that happens with every asset class. In venture, the next iteration will look very different in venture than the past. And I think greater flexibility, selling into secondaries will be a big part of that change.
Yeah, that's definitely an interesting trend to touch on briefly. As companies stay private for longer, the hold period of venture funds also elongates, right? So
yeah.
I think different managers take different perspectives on how they could alleviate that, and one of them is approaching the secondary markets.
Yeah, I think that's right. I think that's going to change, and that's one of the big changes I'll see. I have many friends who are starting secondary funds. I'm open to secondaries with Optimist Ventures, but again, this is what I alluded to in my Medium post. The schools of thought between like Buffett, Berkshire Hathaway value investing versus innovation investing, with the, crazy guy Masayoshi-san aren't that far apart in terms of, making analytical decisions, deep research, incredibly hard work, trying to develop insights that no one else has. There is a common foundation for those things. And when it comes to, investing at especially the Series A stage, where I want to play, those toolkits are more aligned than I think you think.
Yeah.
How do you think about differentiation in terms of one, raising capital from LPs, and then two, sourcing? Because macro aside, we've seen an influx of new funds this year. We're seeing partners leave Bessemer, partners leave Index, people drop out of college to start their own funds. So there's a ton of emerging managers, I think all with different but important skill sets. So would love to hear about how you're thinking about it. And you're being on the younger side, hence you're on the Partner Path podcast.
Yeah. There's a funny Bill Gurley quote from a couple of months ago saying venture, low barriers to entry, high barriers to exit. We should analyze our own business as well as we do others. So in terms of differentiation, I think there should be specialization. I think can you be a master of your own domain? For Optimist Ventures, we've chosen 3 what I think are insider, complex, some structurally challenged, industries, and that is insurance, healthcare, and industrials. And many of the reason why I've chose that is not only are these networks quite proprietary, the data also that I think is going to be created in these sectors, right? Healthcare is 30% of data creation, crazy stat, is very proprietary, out of the way of the large big tech incumbents, by weaving together a network, which ultimately is always going to be the main source of differentiation in anything, with those insiders in those industries, with corporate partners, putting my Comcast Ventures hat on, I think you actually can come up with something that's quite differentiated. So playing in less traveled roads I think is going to be important. Marry that, by the way, with the technology trend of AI, which maybe is, if you think about the technology itself, it's one of greater efficiencies, right? We are getting massive productivity improvements in everything from code generation to media generation to claims processing to operating room enhancement. And with that sort of efficiency gain, I look at the sectors where the problems are most acute, and that's where the solutions are going to be the most remarkable. And so I think of all of the challenges with labor being stretched in the categories I've chosen as an opportunity. So, insider industries is, I think, a clear differentiation. The second is a global network. So I do want to focus on North America. I think that's where the innovation is happening right now. But I think having a global perspective is critical. If you know one ecosystem, you don't know any, because you have technologies and business models that are being tried in all of these different areas around the world. That's very much what I learned at SoftBank and Antler was, there's entrepreneurs who are just as hungry, just as ambitious, just as smart in Singapore as in Silicon Valley. And so having a global network, staying in touch with that, capitalizing on the diaspora flows of entrepreneurs, I think is a pretty critical differentiator as well. So yeah, insider industries, proprietary networks is the only way to go. To reference Brad Feld, your only value add as a VC is to whom you can get connected to and to whom you can connect those people. And I think about that all the time of, how can I connect these different nodes of the network and put myself towards the center of it.
I like what you said about how those areas are poised for AI disruption, but I think that we're in the early days, especially at the application layer. I think we're starting to see bursts of success in areas like customer service and sales, but still even figuring out the longevity of that revenue and just usage. How would you think about market readiness? Because you can find and invest in these companies, but if people aren't buying and using the solutions, you're at a bit of a crossroads.
Yeah, I've seen some statistics on the market adoption across these sectors, that show empirical evidence that there are pilots, there are, working use cases in a lot of enterprises. There's that famous, Andy Jassy came out and said, hey, we saved some ungodly 100 million man hours by shifting a code base using generative AI versus not. And you see 11 engineers working on Cursor, the code AI copilot.
It's good.
Fascinating, right? So there are real world examples here, but I kind of think of it that the inflection point is coming because of whether it is in an inexorable growth in certain metrics of the sectors that I've chosen. So for healthcare, it's admin spend. For insurance, it is, the fact that you have greater data available that's growing exponentially. For robotics, the cost of a manufacturing robot is exhibiting a Moore's law-like decline. And so you look at these trends, and then you see that intersect with the cost of labor in a lot of these economies. And then you also talk to some of the labor, and you realize that they're stretched. They are being asked to do much more than they have been in the past because of the growth of volumes. And they're looking for solutions. My favorite anecdote is a friend of mine runs a robotic food preparation business. It was called Miso Robotics. And there was a Vice documentary about him and the robots, and it interviewed one of the employees in the restaurant. And they said, hey, now that you have this new robotic coworker, are you scared that you're going to be disintermediated? And he goes, well, listen, last week, my girlfriend thought that I was a fry cook. This week, I'm a robotic technician. It is about stretching, having copilot solutions. And this is actually a nice through line of Optimist Ventures. Are we glass half full or half empty about the future of labor in these sectors? And I am cautiously optimistic soberly optimistic that there are technologies that are going to enhance and improve the human experience as they have in the past, whether it's the computer or the calculator or a co-pilot for code generation. And so what's fun about this Optimist Ventures project is it has a lot of meaning and impact about, real world labor challenges and opportunities.
Yeah. People definitely figure out a way to adapt and find whether it's the 10% that they're handling, turning that into a whole career and sector, right?
Yeah.
Is very interesting. I think it'd be great to just touch on learnings from fundraising and kind of actually launching Optimist Ventures, especially given the environment that we sit in today where there are a lot of emerging managers and it can be difficult to fundraise. So any learnings that you've had, I think would be great to hear.
Yeah. So I think 2 learnings on the LP side. The first is it's a very consultative and large enterprise software sale where you have to know a lot about your buyer. So if it's the Danish Sovereign Wealth Fund, then you have to know their aims. If it's a family office in Dubai, you have to understand their history, the business lines that they are in, and how you can help them and achieve their goals. I think my learning is there are fewer purely returns focused LPs out there than you think. Certainly the endowments and the pensions will ask you for your DPI, your realized, unrealized IRRs, all of that. That's true. But there's a lot of capital that continues to go into venture that has other interests or aims. So that's one. And then similar to the point earlier on working in sectors that are less trodden by other VCs, similarly, I think you have to go to areas of the world or non-traditional LPs that I think want to get into venture but haven't quite done that yet. So, you end up overturning a lot of stones, but it's usually the ones that, haven't that really still have appetite for venture after what was, very candidly 4 years of perhaps a little bit of excessive venture investing that, want to do that. So look where other people are not looking.
Yeah, and there's some really interesting trends coming out of, there was a video from the All In Summit where I think Thomas Lafont spoke to the distributions in DPI and venture relative to capital invested, where we're actually the past 2 years have seen negative net cash flow to LPs through a venture strategy, meaning that more capital was deployed than was returned.
Yeah.
So you mentioned LP appetite. I'm curious to hear your thoughts if you think LP appetite for venture will change over the next 5 years.
Yeah. I mean, listen, I think we are back to a more normalized rate of, call it, $300 billion of global investing, half of which is in the US. By the way, China is way down. By the way, within that 150 in the US, half of it is AI. And then of that, most of it's infrastructure AI, which is clearly what at least I think from a venture perspective is not as palatable for me to play in. So the compression in the amount of funding since 2021 days is pretty remarkable. I just think, again, secular, cyclical. Venture is an asset class that I believe in when others, I think, have had some wavering opinions on it. And I think we're going to, at some point, I think it's pretty inevitable in my lifetime that we're going to be getting back to that $600 billion level, globally invested per year, and a healthier balance of liquidity for a variety of structural reasons over time. So yeah, I saw the Thomas Lafont presentation, and the lack of IPOs, the lack of liquidity is pretty tough. But you don't want to make a bet against innovation.
Yeah.
How are you guys getting in front of LPs today? Or do you have any advice for emerging managers who are looking to raise their first fund?
I think I have always kept a list, and I keep it by geography and sector, and just so my first advice is just stay organized and collect names and build genuine relationships over a long period of time. I think one of my learnings from Comcast Ventures and a former Comcast Ventures team called Touchdown Ventures is, corporates are also a very interesting source of capital. That's another angle that I think I've been playing a lot. And then there's all sorts of cool programs. I entered a GP accelerator called Coolwater. There's Equal Ventures has a emerging manager circle that I think is really neat to join. And some of that is community and you're all kind of trading in the same names. But still, I think it is getting out there and going to these conferences and getting the name out, and just the usual ways. And then also go to places that people are not I'm not looking.
Yeah, try and look under the rug and in the corners of the room.
In 2 weeks, I'm going to Riyadh for a conference I've been to the last couple of years.
Riyadh, where's that?
Oh, it's in Saudi Arabia.
Oh, okay.
Yeah. And it is the Future Investment Initiative Summit. And, I've gone the last 3 years largely because I saw, Masa and the Vision Fund executives go when I was there. I helped bring Antler to the Middle East, and I, have tried to develop and cultivate connections out there as well. That is a fascinating conference. It's like you have on stage, it's like Ray Dalio, Steven Schwartzman, and then you have like the little VCs who are raising the $30 million funds, but it's a fascinating perspective. I mean, I'm not getting the invite to Davos, but kind of like a Davos level sort of perspective on what are the major trends that corporations, governments really care about. And that sort of stuff, it may not seem like it with our, $30, $50 million funds as emerging managers, but that sort of stuff, I think, over time is VCs are well suited to think about. With small amounts of capital, as you all have seen at Notable, you can make a massive difference in economies and societies and technology changes. So I think that is one trip that I'm actually really looking forward to that I think will help with the narrative and the fundraising as well.
Yeah, that's great. Let's end with a quick fire round. What's an industry outside of the three you're focused on that people aren't talking enough about?
I think metals and mining, and more specifically like the rare earth stuff. Like you see these battles for like lithium concessions in different countries, and that's driving the EV boom, but there are all these like rare earth metals, and by the way, like 3/4 of them are in China. And so if you're thinking about this sort of decoupling of the West and China, which by the way, I think you guys know a little something about, I think actually that sort of like rare earths, like minerals battle is pretty fascinating because it goes into all of our devices, all of our technologies today. So that's probably one.
What do you think is the most important founder trait an investor should index on?
I think it's a sense of invincibility. It's not invincibility itself. It's this like, my friend Will Ahmed at Whoop talks about this. He had like so many detractors over the years, and just having this like not invisibility cloak, but cloak of invincibility, where you can just like put on this sort of confidence, this sort of, what's right, you're going to drive forward, you're going to show confidence to your team, I think is probably, and that's hard for like first-time entrepreneurs. You see the seasoned guys and girls have that trait, but that's hard. I think it is, some innate and some learned skill to develop that sort of impenetrable confidence amidst detractors.
Yeah.
Who's your favorite person to sit on boards with?
Okay, so finding mentorship in venture is hard, I think. They say it's an apprenticeship business. I haven't seen it yet. But I have an amazing mentor from Comcast Ventures named Sam Landman, who now runs a fund called Mosaic. And Sam was indexed so highly on amazing listener, very surgical with his comments. I've seen him create, through his comments, new profitable business lines on these companies that have actually turned around businesses. He did that for a company we serve. I was his observer. He was the board member on called Kimi, where they were a key duplication kiosk. But they actually, through his comments and his research and all that, he was able to study this affiliate monetization scheme that now makes up a good portion of their revenue. I get pretty involved in my companies too. Like I help my companies do their M&A, like think through acquisitions with market intelligence, things of that sort. So I am a believer that, especially in the boardroom, you can be a value add. There also is a lot of potential harm. So rule number one, do no harm in the boardroom, Hippocratic oath. But the thing I love about this asset class is, I believe you have to be an active, involved, and thoughtful investor and participant.
And what's your biggest company miss?
There's one from the old stories and one new. I mean, Clear, I had brought Karen and the Clear team to committee check-in process. but again, where the problems are most acute, the solutions are most remarkable. So I actually think I loved Clear, how to look it was valued at a couple $100 million. The business model is great. You're effectively being paid to build an identity network. And it's still the early days in the company. But now it's a $4 or $5 billion company. So I'm disappointed that, couldn't get that one through and still have great admiration for what that product could become. I think we'll all be surprised about what that can become in the coming years. And then more recently, I met this guy George from Hebbia, the knowledge management one, and you just meet him and he is insanely impressive. And I would characterize that as probably a more recent miss. Who knows what happens with that category with Glean and Hebbia and knowledge management, but I think had an early look through a friend, incredibly impressive entrepreneur. I tried doing my usual diligence on it, and then it was just moving so fast I couldn't do it. So sometimes you got to make exceptions for exceptional people.
It's a good lesson.
Yeah.
And a great note to end on. Teddy, thanks so much for coming on the podcast.
Yeah, it was really fun. Thank you so much.
We're excited to keep an eye on Optimist Ventures. You guys continue to grow.
Thank you so much.
Thanks, Teddy.